India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a better handover from Wall Street as we wake up this morning, slightly better. And there is a lot to talk about here. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning. And I want to just sort of, right at the outset, wish everyone a very happy Teachers' Day.
Absolutely.
To the early learnings, to the lessons still continuing. I think the market, of course, is the biggest teacher of them all. Teaches us something or the other every day. And this job, of course, I think I've always said it, is just quite incredible. The amount that you get to learn if you want to.
Absolutely. Good morning, guys, and good morning, viewers. Absolutely. And, Teachers' Day is one day when you look back and remember all of those individuals, those teachers who made that contribution. You probably didn't know it at the time, but in hindsight, you realize that's where the inspiration and the confidence and, so many of those dreams came from. And like you mentioned, Prashant, our profession itself, we've learned so much. Been very lucky to be working with some of the very best. Inspiring thought leaders, people who've kind of, told us to hold the torch high and keep asking those tough questions and keep seeking information and the right answers.
Well, that's right. Happy Teachers' Day to all those teachers out there who are professionals, and also the markets. They are the teacher that teaches you something new every day. You're as good as yesterday's session. And Happy Teachers' Day to both of you guys as well. I think in terms of experience, I'm a little lower than both of y'all. Learn a lot from y'all, not just about markets, but about life as well and how you navigate things. So happy Teachers' Day and happy learning to all of us.
I can say that to you as well. I was just going to say, but you stole the last phrase. Learning's about life. We learn a lot from this guy.
There was also a slight poke at the age, our age.
I see now.
All right, let's take a quick look at what you need to know as far as market action is concerned, right? So equities last night were a little flat. They were sideways, nothing large in terms of a cut or anything of that sort. But it was down. S&P was down about 0.16. NASDAQ was down about 0.3% or so. And that's the picture out there. Now, the big talking point, of course, was this entire AI semiconductor chip stocks, right? They were down once again. NVIDIA, after the near 10% fall, was down another 1.6% last night. So that complex is looking a little weakish. You had yields which came off about 8 basis points. We're down to about 3.75%. You also had the dollar index, which is now down to about 101.27. So about 0.5%, nearly 0.5% cut there. You had some numbers, the JOLTS data, which basically shows job openings in the US economy. And for July, the number that we got, there was unexpectedly fell sharply. And but without going into the numbers, it's the lowest level since early 2021. This is, of course, one data point. The big one, of course, is going to be tomorrow when we get the monthly NFP, which is the non-farm payrolls report. Remember, in early August, that is the one which triggered, along with other things, the yen, etc. But that is that Friday data point, end of July, that really triggered this market mini crash early August or so. So I think tomorrow is important in that sense. Just two other things. You got the USD JPY, which has now come up to 143 levels. It's essentially 2 weeks back, we were in we were talking about the USD JPY in the 147 handle. We are back at 143. Pre the early August, that we were at about 160, 162. And then there was a rally all the way to 142, and that's essentially what caused a fair bit of fear in the market. We're back at about 143. So the yen basically has rallied against the dollar and rallied hard once again. Oil prices, we're at about 72. Lots of noisy OPEC headlines. We can talk more about this. As I said, the jobs number tomorrow has got the potential to move markets. Whether it'll do or not, I think is the question. A 25 basis point cut in September when the Fed meets, I think is largely in the price. Can it be 50 is the only question. I've said this before, I'll say it again. Markets would like 25, not 50. 50 will sort of smack of some fear and markets will wonder whether the economy is deteriorating faster. 25 is like a gentle glide path, which I think the markets will live with. Even and they'll say, well, it's Goldilocks and economy is strong and you're getting rate cuts, so well, what's to worry? But 50, I mean, throws those equations a little unbalanced there. Now, just to circle back to the levels here, I mean, I think on the Nifty, the near-term support is yesterday's low, because we had a nice clean 100-point bounce. So 25,083 is yesterday's low. That number should be the first line of support. And on the upside, I mean, targets are the same. The swing high, which we took out, 25,333 is the swing high now, and 25,530, which is the retracement, extension retracement of the earlier move. So that's the Nifty. On the Bank Nifty, yesterday it held an important support of 51,240, so that becomes sort of something to watch out for. The 20-day comes in below that at 50,789. I'm talking about the Nifty Bank, if you can move the graphics along. Support 51,240, and then the 20-day at 57.89. And on the upside, targets are essentially 51,750 and then 51,945. These are very near-term key resistance levels which the Nifty Bank needs to take out. GIFT Nifty will come up on your screen, giving you a sense of how the start is going to be. It's a nice 100-point higher start this morning. Surabhi.
Yes, absolutely. I mean, I think playing for a bounce, that's what bulls will go with, at least as we start off, because Asia seems to be a bit on the recovery path, though Nikkei is not quite playing ball. There's still some red on that screen, and the Hang Seng is flat, flip-flopping between red and, red and green. Just a word on oil, because Prashant mentioned this. Let's bring up oil prices. Yesterday, by the way, WTI fell below $70 a barrel. 69 is the last print. Just around that level even now. And Brent is tracking 73. Now, these are 9-month lows on oil prices, which has been working well for some of our stocks like paints, tires, etc. The talk is that OPEC Plus might now delay the increase in output that it was originally planning in October, looking at this reaction in the oil market, and that Libyan issue has resolved itself. So I don't think we are getting an outage from Libya. Because of all of that, this fear of excess supply, low demand, we are seeing 9-month lows on oil prices. But anyway, to get back to this whole point of whether we'll get the 50 basis points rate cut or a 25 basis points rate cut. Yesterday, we had commentary from one of the Fed officials. This is the Atlanta Federal Reserve President, Raphael Bostic. He says, we cannot wait until inflation has actually fallen to 2% before removing restrictions, because that would risk the labor market disruption that could inflict unnecessary pain and suffering. So basically, raising expectations that we might get that bigger number. The odds now, if you go by the CME Fed Watch, the odds of the 50 basis points rate cut now stand at 45%. This number was much lesser, around 30% till about a week back or so. So let's see how this plays out. Remains a very key watch point. And the jobs data on Friday will give us a lot more clarity on which way the Fed could perhaps swing. Back home, let's talk about the flows. Now, we've got FIIs buying to the extent of about 975 odd crores. DIIs were net buys. The net number on the DII side was a little lower, but there are so many block trades happening that are skewing the data on a daily basis. So I went back and checked the final numbers, not the exchange numbers, but the depository numbers. And they tell you a picture, something that a lot of our guests have been pointing out. FIIs are coming in the market. It's not like they're not, but they're coming in via these block trades. They're looking at these strategic, buy-ins, because the numbers have been all positive. May was the last negative number. June, July, August, September, all positive. July's buy was about 32,300 crores. In September so far, just 2-3 days, because of the kind of blocks we're seeing, the positive FII number is already in excess of 10,000 crores. That's just the nature of the action in the market. Quickly coming to some stock-specific action worth watching out for today. Reliance, remember, today is the board meeting to discuss that 1:1 bonus. So we'll see how that plays along. There's a buyback that is being considered by Matrimony's board. Remember, the stock zoomed almost 10% when that news came in. So today is the board meeting. And finally, we will get a new entity from the House of Raymond, the lifestyle business, the branded apparel business that lists out today. I was trying to look at the numbers that are doing the rounds. And one of the reports, this is Antique, said that the fair value of this business, if you go by FY27 numbers, should be around 180. And then, of course, it depends on how charitable the market is feeling and what kind of a number we actually get on the listing. But enough to keep us busy. Global cues, lots of local stock developments as well.
Well, that's right. And today, in fact, global cues are far more stable than what we woke up to yesterday. And, if you look at yesterday's trading session, it was a beautiful one because the dips got bought into and the Nifty cut its losses by half by the time we wound up. So a big recovery is what we saw from the low point of the day. If someone told you, at the start of the trading session that you'll end low by less than 100 points and you'll have institutions that were net buyers, well, the bulls would have grabbed it with both hands. So India continues to outperform, and that's a positive because these dips are getting bought into. What about positioning in the index futures? We have two big participants out there. The clients, well, they cut some of their short positionings in yesterday's trading session. So there was a bit of short covering that we saw in trade from the clients, which is good news. That's telling you that they're, maybe not expecting a sharp decline from here on, and they are the ones that have got it right. So that was about the clients. And on the FI side, well, there was some unwinding of long positions is what we saw in yesterday's trade. Moving to the PCR, well, that was at around 1.45 a few sessions ago. That's come down to more palatable levels of around 1.1 odd. How did that take place? Because we've seen call writing that came back. And now these call writers, going by the opening, they'll be getting a little bit nervous today. 25,200 call, 25,300 call, massive open interest built up out there. And these call writers, going by the bounce that we're seeing, we'll have to keep an eye on both these two. Will there be some unwinding seen at both these two strikes, which will tell you the bears are getting nervous now. They thought that they could protect the higher levels. So we'll have to see some follow-through buying post the start. Which brings us to the levels. Going by the options data, and today is the weekly expiry, so these contracts will expire. You have the crucial resistance zone at around 25,320. That's around 120 points away from where we ended yesterday. So that's the important mark. We need to get past that to sustain a bigger bounce. Yesterday's low becomes a reference point in the near term, so that could be, the support level. And, the bigger support comes in at around the 24,700, which most technical analysts don't expect to break. So those are the levels on the Nifty. The Nifty Bank, that recovered yesterday from 51,250, which is the level we pointed out yesterday morning. But it needs to get a little bit higher, from past that 50 DMA, which is around 180 points away from where it closed up yesterday. So you wanted to get past that, then it's well and truly on its way to around 52,000 odd. Looking at the stocks in focus, yesterday we had some of these cement stocks that came off the low point of the day. Some of the input costs are cooling off as well. And after a while, we're seeing that, cement prices, some of those price increases are sustaining. So the stock I'm looking at is Ramco Cements because it's got past the 20, 50 and the 100 DMAs. The 200 DMA, which is around 30 rupees away. So I'll keep an eye out on this one. Quality name from South India, lot of headwinds. But if this price hike sustains, then maybe that's a stock that we should be focusing on.
Nigel, thanks very much for that. So keep an eye out on cement, right? By the way, here in Mumbai, it's raining. End of the monsoon season, it's raining harder now, I think, compared to the last 2 weeks. But good news, I was reading that the lakes which supply water to Mumbai are 97-98% full. And the fact that monsoons have extended so late, which means that, you're not looking at water cuts, etc., early on, like we see in April
it was
May,
a bit of a late onset as well, I think. So the expectation was that maybe we'll have a bit of an extended period.
Ganpati, right? So normally,
it does rain around Ganpati time.
And I think that usually is sort of marks the end as well. Well, we'll talk about sort of some of the local cues, but let's go back to the global stuff, right? Gargi Pal Chaudhary is head of iShares Investment Strategy, Americas at BlackRock. She's with us now to take some questions. Gargi, great to have you with us here. Thank you very much for your time. Prashant Desai, it's good to see you here on the channel. I hope the first of many. I want to start with, we'll get to the US in just a bit, but the dollar JPY back in the 143 handle now compared to 147 just 2 days back. What's going on? And do you think it's got the potential to once again sort of induce some fear in markets? Or do you think it's one and done? It won't cause the same kind of impact again. Your thoughts?
Sure. Good morning. It's very nice to be here. Long-time listener, first-time joiner, and thrilled to join you and your guest today. Starting with your first question on the dollar yen, look, I think that we're leaving this environment of a lot of liquidity, a lot of reserves, and more moving, at least in Japan, to an environment of more restrictive rates. And I think when you move from an ample liquidity regime to one of more restrictive policy, you are going to have to get used to a certain amount of volatility in the markets. And we certainly saw that in the beginning of August. Some of the positioning, we obviously look at, much like I'm sure you do, look at some of the non-commercial partial yen futures holding, forwards holdings, and to some extent, some of those have been unwound, some of those shorts have been unwound. But I think as we get to restrictive levels, and for sure the Bank of Japan is going to continue to move towards higher rates, I think we should get used to some periods of volatility and expect them to be a part of normalcy in our markets. I think just as we saw in the beginning of August, it created an opportunity for those that were patient and willing to sort of stay the course.
Yeah.
Gargi, just to finish that point, you know, this was, I think, early this year, or it was last year. There was someone who said, who called Japan's rising interest rates as the San Andreas fault line of finance. That got a lot of play, obviously, because of how it was phrased. But I think yesterday or day before, you had the head of fixed income at T. Rowe Price, who essentially warned that, and I quote, "We've just seen the first shift in that fault and more is to come." You wouldn't sort of, listening to you wouldn't go that far, right? You're saying, well, markets will very quickly get used to this.
I just think that we are going through a massive regime shift globally. And I think what we have now begun to see in Japan after many decades will take investors a little bit of time getting used to. I don't think that every single move will be a 12% drop like we saw in the Japanese equity markets in the beginning of August. But I think to expect no other ramifications of a rate hiking cycle is a bit too optimistic. So I do think, again, as I said, if we move to more a regime of more volatility in the markets, a regime of more restrictive rates, we can possibly see some further carry unwind trades, which is kind of what we saw in August. And I think volatility is really poison to those carry unwind trades. And I think I don't expect this to be anything that's going to shatter global market liquidity. I think if anything, it gives us opportunity to pull back, reassess our views on where we think markets make sense, whether that be in Japan, India, or US, growth versus value, and look at better levels to reassess and enter markets. And that is exactly what we told investors to do for the Japanese markets earlier this month.
All right, Gargi, interesting point, and makes a lot of sense, right? That there's no point expecting that this one-way ride, the one-way yen carry will just, carry on forever. So take your point. I think August has taught us that, this needs to be watched with a little more nuance. Okay, let's talk about the U.S. market itself then. You look at investment strategy across Americas. And here we're dealing with two issues. One is what's happening with the economy and whether we're getting a soft landing or not. And maybe to an extent, the Fed fixes that with the rate cut. And the other is this whole issue around AI, right? The volatility that we're beginning to see in the tech space, in the semiconductor space. What are your thoughts? Are you still constructive on U.S. equities?
Sure. So we'll start with the first one, which is just around, the normalization of interest rates that we think is going to happen later this month. I think the Fed has prepared us in the Jackson Hole meetings that took place at the end of August. They very much prepared us for the rate cutting cycle to begin later this month. Now, the question is whether they go 25 or 50. I tend to be in the 25 camp. Obviously, the market's pricing in about, as you had said earlier, a 50% or so chance of a 50 basis point rate cut. But I think they want to be a little bit more patient. And obviously, inflation isn't back at their target, certainly making a lot of progress, but isn't quite back at their target yet. And I think that just this act of normalization of policy, just this idea that the Fed is now focused on their dual mandate, and that's one of the things that was most important in Jackson Hole, the Fed saying that right now they don't welcome any further weakening. They don't want any further weakening in the labor market. That brings back a lot of optionality for investors looking at both bonds and equities. To the second part of your question, I think September and October in the US tend to be pretty seasonally volatile. We've seen that over the last decade when you look at, what equity markets, whether you look at small cap, whether you look at large cap, whether you look at more of the tech stocks that you're talking about, wherever you look, whichever corner you look at, we have historically seen some volatility in both September as well as October. Now, on top of that, you do have other macro event risks, such as the US election. So I think that it is okay for us to get used to, like I had said, even with Japan, Japan. I think even in the US, we saw that in the beginning of September already. I think that we should expect some volatility, both in equities as well as in bonds in this month. Be ready for that. I'm telling my clients that's okay. Volatility is normal seasonally at this time of year, especially going into the US elections. We certainly think in the 6-12-month forward picture, high quality US equities will continue to do well as long as, growth, which we think is continuing to be very close to or above potential. The Fed begins their rate cutting cycle, which has again historically been very good for both stocks and bonds. So the longer term picture, if you look 3-6 months out, looks really good. For the months of September and October, again, depending on your time horizon, I think we can see a little bit of volatility. And I think investors should get prepared for that and not be spooked by that.
Okay, Gargi, good morning from here in India, and good to see you in. This is Nigel on this side. So plenty of pieces of the global puzzle and bracing for some volatility in the near term. But what about an emerging market like India? We have been a big outperformer. Earnings growth looks good out here. Political stability as well as something that, we boast of. But at these valuations, what's the view on the Indian markets from here on?
Yeah, I mean, it's been my absolute privilege and pleasure to talk to investors across the Americas. So I cover US, Canada, and Mexico, and talk about my country of birth and where I've studied and grown up, which is India, obviously, as you can tell. And the story has been wonderful. And I think that, yes, valuations are at the higher range of the whichever historical period you look at. But I think there's another broader story here, especially when I look at portfolios in the US for US investors. There is an underinvested story that is true of India, certainly, but true broadly of emerging markets. So I think this isn't even about valuations. As India becomes more and more important to the global economy, as it already is, but as we continue to take our place, take our seat in the global stage, I think investors need to at least get back to benchmark weights with respect to EM and with respect to India specifically. And I think that is the opportunity. Now, can we see some volatility, especially as you pointed out, around these valuations, as well as the point that I was making earlier around a little bit of US seasonality in September and October? Absolutely. But from a long-term perspective, as I said, it's been my absolute pleasure to talk to US investors about the opportunity, about the medium to long-term opportunity in India, which isn't going away anytime soon. And I think investors need to continue to move towards a benchmark weight, even if not an overweight position, to emerging markets and India specifically, which they are not at currently. So I think there is more of that trade to go. And again, nothing is ever a straight line. India, obviously, after the elections, provided a really good opportunity for investors. We've seen a really nice outperformance. I think we can see some pullback, but it's not the end of the world.
All right. Rarely ever is, right? Thank you very much, Gargi. Appreciate you joining in, and it's a pleasure having you here on CNBC-TV18.
Absolutely.
And as I said, look forward to many more. Appreciate it. Well, we'll take a quick commercial break here. We'll come back with more, but just want to leave you with some sort of calls and other views as well. This is Rajiv Batra of JP Morgan, who says that expectations for H2 2024 remains one of recurring volatility and a broadly challenging directional outlook for equities in aggregate. He says Goldilocks is well priced in and risks are skewed towards weaker growth outcomes. He says markets will also need to contend with uncertainty about the US election in the coming months, but will likely get a liquidity boost from Fed cuts before that. In these conditions, Rajiv adds, defensive, quality and income strategies are likely to be outperformers, and this will be helped if the recent volatility in AI names starts to moderate from here on.
Okay, let's move to the next call. This one's coming in from Rhythm Desai of Morgan Stanley. He says India has become the largest weight in the MSCI EM index, overtaking China yesterday. Likewise, he says India's weight in the EM index is knocking on the threshold to be the largest. He says India remains their top pick in an EM context and number 2 pick in an Asia-Pacific context. He thinks a correction in stocks could drive money on the sidelines to pour in, making such corrections relatively shallow.
Okay, well, on the rupee, we have Paramidal Sinha of Standard Chartered Bank, who says that the dollar-INR pair remains stuck in a tight range over the week, even as the dollar index turned volatile. Dollar demand from local banks remains strong, and was primarily due to forex reserve accumulation. MSCI rebalancing inflows were completely absorbed by the local banks, while risk-off in equities could lead to FPI outflows in the coming week. Volatility in the rupee is likely to remain low. She's expecting the pair to be between 83.8 to 84.15 in the near term.
On bonds, Powell says global yields remained range-bound last week ahead of key non-farm payrolls data due on Friday, which is likely to be the most important data point before the 18 September FOMC announcement. Due to lack of domestic triggers, Indian bond yields traded in a 2 to 3 basis points range for the whole week. Robust first quarter GDP data, continued RBI hawkishness in policy rates, and OMO sales have led to limited rally in India rates. Continued FPI flows, softness in global rates, and lower commodity prices are supportive and positive for rates in India. In the near term, Powell expects the benchmark 10-year bond yield to trade in a range of 6.8 to 6.9% for the coming week.
Well, we've got a lot of stock-specific action to track for you in our special Top 10 segment. For the time being, we run you through the list. We're looking at Reliance, Apollo Hospitals, Suzlon, Kalpataru Projects, Allied Blenders, and Linde India. All of them will be reacting to positive news flow, while we have 4 stocks that will be reacting to negative news flow. Sona BLW, Glenmark Pharma, Mastec, and Thangamile Jewelry. I'll tell you what, we'll slip into a short break. You come back, we'll get into further detail on all these names. Stay with us.
Welcome back. You're with us on Bazaar Morning Call, and it's time to talk about a lot of the stocks that are going to be in focus today. So our team is standing by with the list of top stocks to watch. Guys, good morning. So plenty to track today. There's a lot of news on Reliance aside of the board meeting and the bonus. So Darshan, fill us in on the latest.
Morning, Survi. So I'm going with green for Reliance Industries on the back of two news. First, company has secured 10 gigawatt advanced chemistry cell battery storage capacity under PLI scheme. Heavy Industries Ministry had received total 7 bids. Of that, Reliance has emerged as the successful bidder. Remember, in May 2021, Cabinet had approved ACC battery storage PLI scheme with total outlay of more than rupees 18,000 crore. Besides the news, there is a board meet of Reliance Industries in which board will consider bonus issue in the ratio of 1:1.
Okay, all right. Thanks a lot for that, Sudarshan. So that one will hold one end up going by its weight on the index as well. But Vivek had given us a sneak peek into Sona BLW yesterday with an exclusive story. Vivek, tell us more, and congratulations on another news break.
Well, good morning. Sona BLW, like you mentioned, last afternoon, we did tell you that the company was on a fundraising plan. And along expected lines, last evening, the company launched its QIP. And, according to the term sheet that we accessed last evening, company is looking to raise up to 2,400 crore via the QIP route. Remember, the company already had taken approval from the board in July 2024 to raise the exact quantum. We understand that the indicative issue, price range for this particular deal is in the range of 675 to 700 rupees a share. At the lower end of the price band, the equity dilution is close to 6% of the total equity. Now, more importantly, we had indicated that there could be an M&A in the offering, and as per the term sheet, the usage of the proceeds along with debt repayment and to go ahead and increase its stake in closing out the transaction of Novelic. The company has also mentioned that the company will be pursuing strategic investments and organic as well as inorganic growth opportunities. So we'll wait and watch by for this QIP to conclude and what eventually they do with the proceeds of this particular fundraise.
All right, Vivek, thank you very much. The story on Sudarshan Chemicals, now the story on Sona, and Vivek, I hope there is more coming. Pressure is on you, but that's exclusive once again. Well, let's talk about pharma, right? I mean, stocks have been doing very well. Glenmark and Apollo Hospitals should be in focus. Ekta is here to tell us why. Ekta, good morning.
Thanks. I'll start with Glenmark. I expect that stock to be in the red today. That is because they've settled with the US Department of Justice. This is on the settlement on False Claims Act and anti-kickback investigation against Glenmark. So the company is going to be paying $25 million in 6 installments over 5 years. They're going to be paying an interest of 4.25% per annum from the 28th of May. The settlement does not contain any admission of liability except to the extent that Glenmark had admitted it in August 2023 in a deferred prosecution agreement. So you can look at it two ways. You can also look at it as an overhang being lifted for Glenmark, because these kind of settlements are quite regular for pharmaceutical companies in the life cycle of their businesses. Now, Apollo Hospitals, I expect that stock to probably be in the green. They're going to be incorporating a wholly owned subsidiary, Apollo 24/7 Insurance. And this is going to basically work in life insurance, general insurance and health insurance. They will be working as corporate agents. They'll act as agents. They'll engage in all activities which are incidental and allied or related to the insurance business. Remember that Narayana has started their own insurance arm after this. Apollo Hospitals has as well. So it'll be interesting to see the stock reaction there.
Okay, all right. Thanks very much, Ekta, for that. Well, back to Sudarshan. He's watching out for a bunch of other stocks as well that are in news today. Sudarshan, which ones are these?
So I have like 4 stocks. So we'll start with Suzlon Energy. It has announced sale of non-core asset that is named as One Earth Property. It will be selling to 361 AM for rupees 411 crore, and on completion of sale, this property would be leased back to company for up to 5 years. Next is Kalpataru Projects. It will be prepaying non-convertible debentures worth rupees 50 crore on October 4, and to prepay NCDs to recalibrate its debt portfolio. Allied Blenders to acquire 80% stake in JV to be formed with O50 Talent, and company will be investing rupees 70 crore. This O50 Talent is represented by actor Ranveer Singh, and this JV will undertake business with respect to manufacturing, distribution, licensing of luxury and premium spirits. Last is Linde India. It has entered into plant sale agreement with Tata Steel, and it will be acquiring its industrial gas supply assets as Kalinganagar project.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's go back to Vivek. He's here to tell us about a couple of large trades that took place yesterday. Vivek.
Well, that's right. Yesterday we did see quite a lot of block deals that happened, and the one that took place, in the last hour of the session was the large block deal that you saw in Mastech. Now, remember, in Mastech, Capital International actually held close to 7.94% in the stake in the company, and this was under the name of Small Cap World Fund. Now, as per the exchange disclosure that's come in last evening, Euro-Pacific Growth Fund, sold close to 5.6% stake. But remember, both of these companies, come under the same entity. What's actually been disclosed is the total 5.6% stake. Amongst the top buyers, ICICI Prudential Mutual Fund as well as the Gisalo Master Fund, both of them have picked up at almost 2.5% in the particular deal that took place last evening, last afternoon. The other stock on the radar is Tangamail Jewelry. Now, 3 promoters have equally paired stake. All 3 promoters have paired close to 1.5% stake. All of the promoters held close to 20% stake at the end of Q1. The buyer actually was Amundi India Small Cap Fund. They've picked up close to 2.5% stake. So again, Tangamail Jewelry, promoter pairing stake. Expect both of these stocks to react a little negatively in the red on the back of the supply overhang that you might see.
All right. Got it. Thank you very much, Vivek, for that. So let's quickly recap our list of stocks to watch today. Here are the ones that have positive news surrounding them and sentiment surrounding them. Reliance Industries, Apollo Hospitals, Suzlon Energy, Kalpataru Projects, Allied Blenders and Linde India. Stocks with negative sentiment around them are Sona, BLW Precision, Glenmark Pharma, Mastech and Tangamail Jewelry. Well, that's the stock list of the morning. Let's quickly now head across to Manisha Gupta and get a roundup of all the commodity market action. Now, Manisha, good morning.
Morning, Sylvie. Thank you for that. Well, after yet another day of decline, well, right now there seems to be some stability, steady moves coming in for crude oil prices, and this is after prices hit a 14-month lows in the overnight intraday markets there. Well, there are reports now that the OPEC and allies could delay output increase that was slated from the month of October, and that really seems to have led to some stoppage in sense of selling here. Is there more buying happening right now? No, it's not, because the markets are waiting for further, clarification or a concrete statements coming in from OPEC as of now. We do understand that Libya resolution is already increasing supplies. Non-OPEC supplies seem to be increasing as well, and the global inventories are slightly on the higher side. And various reports in recent days have been revising their outlook on crude prices for this year and the next year quite on the lower side. So until something that can be heard from OPEC, as the report suggests right now, the crude oil prices would perhaps stay where they are. The declines, though, have been seen in case of base metal prices, and quite sharply there. The China PMI declining for a fifth straight month, weak demand, increasing inventories have continued to weigh onto the prices. So today is yet another day where you have copper, steel, aluminum, all of these metals starting Asia on a weaker note.
All right, Manisha, thank you very much for that. So that's essentially commodities, base metals, oil, everything in focus. We take a break. Hemang Jani will be with us for some fundamental stock conversation. Stay tuned. That's coming up.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, we've listed down all the stocks that you should be tracking. To help us out with some fundamental analysis, Hemang Jani joins us on the show. Hi, Hemang. Good morning and good to see you. And well, I wanted your view on the big boy Reliance Industries. You know, that's that corporate action meeting that will take place later today. And also overnight, we had news that the company has bagged the 10 gigawatt battery storage PLI benefits worth around 3,600 crores. This one could hold one end up. What's your view at current reckoning?
Yeah, good morning, Nigel. Thanks for having me. I think this would be the first approval that the company has got for building a 10 gigawatt battery storage project. And I think the total budget that the government had outlined was about 3,620 crores. So while in terms of the size or the amount, this may not be too big given the overall size of Reliance Industries. But the fact that they've got this project and this will mark the foray into the clean energy, that we call it. So surely it's going to be a big positive sentimentally. And given the overall pipeline that Reliance has in this particular area, there is going to be some sort of a positive reaction. At the same time, Nigel, we should bear in mind that the refining margins have come under pressure. First time Singapore gross refining margins are quoting at a negative tick. So I think we will also have to consider a bit of a negative because of the refining margins part. But overall, our view on Reliance at current level is quite positive.
They have, I think, point taken, Hemang. I think the first PLI round, they got 5 gigawatt hours, and now they've got 10. And the stated aim, of course, is much bigger. I think from what I remember is 50 gigawatt hour by 2027. So to have one of the largest capacities in the space, really, that's the ambition. Just a quick word, Hemang, on, if you will, on the drop in oil that we've seen. And, from a trading perspective, up and down, I mean, we had the big losers in the upstream oil companies, Oil India, ONGC, etc. They all lost. But more importantly, on the downstream front, what's your sense? The marketing companies, HP, BP, they make sense?
Surely, Prashant, good morning. I think, given the way the crude has moved a large part of this year, I think it's been, positive for overall as a country and as from a stock market standpoint. And more so given the recent weakness that we have seen in the crude oil price, despite geopolitical tensions, definitely bodes well for oil marketing companies, though we have seen a significant re-rating, of this particular sector. The fact that, you will see, some sort of a relief in terms of the margins part, the marketing margins per se, if the companies do not, do imminent price cut, would surely be positive. The stocks have actually gone nowhere in the last 2 or 3 weeks. So within the pack, we like IOC and we do like HPCL also at this point.
Okay, all right. Hemang, stay on. We'll have more questions for you in just a bit, but we also have to welcome in our first corporate guest on the show today. The company in focus is CCL Products. Well, the stock has been doing rather well. It's up almost 28 to 30% in the last 1 month. And just, look at the price move yesterday. 15% just yesterday itself. But there is some concern around elevated global coffee prices. Arabica coffee prices have hit 13-year highs. To talk about this and, of course, to get a sense of the company's outlook, we have with us Praveen Jaipuriar, CEO at CCL Products. Praveen, great to have you with us. Good morning. Thanks for taking this call. So let's start with the global outlook. Considering we are looking at these multi-year highs with, I think, insufficient rainfall in Brazil and perhaps a lower yield there, what is the situation right now and what is the flow through? What is the impact, if any, on your business?
The global coffee prices remain to be at very high levels. And this actually started a couple of years ago when the Brazil Arabica crop was affected due to frost and all. And while this year the Brazil crop has been good, there are reports that the Vietnamese crop could be in short supply because of El Nino effect. So these kind of supply constraints is leading to high coffee prices, and that remains right now. Only after, generally the price trends become clearer once the harvest season comes. And there are two large harvest seasons across the globe. One is the Brazilian harvest season and one is the Vietnamese. So Brazilian crop was good this year. However, that did not lead to a lot of reduction. We are expecting that the Vietnamese crop will come around November, December time. And that's the time we will get to know how the prices will pan out in the future. And really it is now anybody's guess that how will it pan out, because there's a lot of, with these kind of price increases, a lot of speculative tendencies creep in the market. So that's that's on the.
Sorry to come in. Take your point on we need to sort of see if the price surge sustains or not. But the fact that prices have been higher, has that had any impact on your volumes? Because I think your volume guidance is 10 to 20% for the current financial year. Do you stick to that, or is there some tendency to put off purchases or to go for perhaps slightly lower sizes or lower volumes?
So I'll begin with the consumption. Fortunately, even with high coffee prices, we haven't seen any consumption change with the end consumer. So yeah, people are still drinking coffee. And generally, because we are in the instant coffee segment, which is largely in-home, where the price pinch could not be as big as an out-of-home consumption could have. So we are not witnessing any consumption, pattern changes, and therefore our volume guidance remains like that. It also doesn't impact our margins because we work on a cost-plus model. The only change that we have seen is that because of the volatility, the clients or the customers, they're not willing to bet long, in the sense that they're shortening their contracts. Earlier, when the price stability was there, they would probably go for a year-long contract, 1.5 years contract. But now they are limiting themselves to a couple of months because they are also in a wait-and-watch method.
All right. Hi, Praveen. Good morning and good to see you. Yesterday, the stock price spiked up, and that's the only indicator that we have. I understand that there was some fund buying, maybe a couple of family offices as well were buying, but you'll get the bank post later this weekend, so you'll come to know on that. Basic understanding is coffee prices moving up. It's not had an impact on demand, as you're saying, so your volume guidance is intact. What is the volume guidance? We had a wide range of 10 to 20%. And I also wanted to ask you, since as you mentioned, you're a converter, your working capital cycle could get stretched, right? Because coffee prices move up. Tell us about that.
Absolutely. So, the reason why we widened our guidance was simply because of the fact that I mentioned that earlier, maybe a couple of years ago when the prices were stable, we used to get very long-term contracts. And actually at the start of the year, we were very clear that what will be our volume volume growth for the year. But considering that people are a little more, wait and watch this thing, the clients are not very committal in terms of long-term contract. So therefore, we widened our guidance because there could be some clients who would start working on lower inventories at their end. And that was the reason we gave a little broader guidance. And sorry, the second question
on the working capital gets stretched a little bit, or it's manageable? Yeah.
No, absolutely. Working capital stretch has been there because we are growing volumes, and on top of it, the coffee prices have gone up. So it has got a double impact on our working capital. But the only good thing about our working capital is that all the working capital that, because we work on a cost-plus model, all the working capital that is deployed is for confirmed contracts. So only if the contract is confirmed, we go ahead and buy coffee at the back end, which means that this working capital, every penny of it is actually, sold.
Okay, so just to confirm, volume guidance you're keeping at 10 to 20%. I also wanted to ask you about the EBITDA per kg. I think it was at around 105 odd. But since your mix is going to change towards FDC, that's likely to see some kind of a booster shot. So what is it currently? Where does it move to?
So yeah, it's currently at the similar levels as you talked about, 105 or so. And, while FDC will also come in play, we also have now extended capacities of spray dried as well. So we didn't, we don't expect because one will offset the other. So we are maintaining the same guidance for EBITDA per kg for the year. Of course, we are working constantly on building more efficiencies because at tough times you kind of build more efficiencies. But in terms of guidance, we are not, kind of changing that in the short term.
Praveen, hi, good morning. Prashant here. And I think we're speaking after a while. So good to see you here. And we're talking to you as we consume copious amounts of coffee here. So, I mean, looking at this coffee consumption in the studio, I can tell you that demand is not going to be a problem. If this is a sort of, any indicator. So in terms of top line, for 25, you did 730, sorry, beg your pardon. I think for the full year, FY25, if you can give us a sense of what the number will be on the top line front. You did 2650 crores, for last year. That is FY24. What could the number be for 25?
So generally, if our volume guidance is in between 10 to 20, you could expect another, 10% or close to that price increase advantage that the top line would get. So, anything if we land in between 10 to 20, the top line could, the value top line could land in between 20 to 30. So that's the kind of guidance. But generally, that's not the volume guidance is the guidance we look forward to. That is the reason because even the EBITDA will grow in line with the volume. So if the volume grows by 10%, the EBITDA will also grow by 10%. So that's the real, marker for the business that we look internally.
And that is the EBITDA per kg number, 110 rupees.
Yeah.
That's the...
Yeah, 105 to 110 rupees. Yeah.
Okay. And got that. Could you just very briefly break up the market segment for you now? How much is institutional, how much is going to, the branded and just the overall breakup?
Yeah, so I think probably you're asking about the branded business now. So branded business, we did in India, the total India business last year, we closed at around 300 crores or so. And out of that, 200 crores was pure retail, which is our own brand. So that's the kind of, segmentation that we have got internally. Out of the branded business, we probably, end up doing 50% from the general trade, which is the Kirana stores, another 20% or odd from modern trade, and another 15 or odd percentage from e-commerce. So that's the kind of breakup we have for the domestic business. The brands are also doing really well. We probably are looking to drive a 40 to 50% growth this year, and from 200 crores, we are looking to close 25 at around 300 crores, maybe 10, 20 crores here or there.
And finally, just a last takeaway, as you grow this branded business, and I think the freeze-dried coffee plant is coming on stream, Vietnam, the expansion is on. When do we see CCL products go back to the 20s when it comes to EBITDA margin? Because I think last several quarters, the run rate's between, 16% to 18%. You used to be in the 20s not too long ago. When do we see that happening?
So, okay, two things. First of all, actually 20 to 16 is not a reduction because, you are looking at EBITDA percentage with respect to top line, and the top line is getting the price because we work on a cost plus model. It's getting that price while the top line is getting that price advantage. The EBITDA to the top line percentage looks, it's optically looking down, but it is not because my per kilo EBITDA is not coming down. So, now it's a very tricky thing. If the coffee prices were to come down, automatically you will see that the price, the EBITDA percentage to top line will go back to 20. So, the better this thing marker to look at is
would be EBITDA per kg. Got
Yeah,
it.
and it's something that we think that over a period of time will keep improving because we are focusing a lot on branded business, small packs, more premium and specialty coffee. So we are
Got
working
it,
on.
Praveen. We'll leave it there. Thank you very much for joining us and appreciate you being here on the program on CNBC TV18 this morning. Good luck. We'll take a break. Mitesh and Sudarshan will be with us with some technical trading ideas. Stay tuned. Coming up. Okay, welcome back. We've got the market, which is about 5 minutes away from the pre-open session. We have Mitesh Thakkar and Sudarshan Sukhani who are with us. Gentlemen, good morning. Good to have both of you here. Mitesh, you go first. How are things looking? I mean, a gap up is what the indication is. Would you be willing to be a buyer in that, or would you wait for a dip?
Morning, Prashant. I presume I would want to take a long trade. One, I think, we might open near the previous high of 25,300, 330 zone. Yet, I think, the overall evidence does point towards continuation on the upside. The setup is quite positive. Yesterday's gap down was immediately bought into, and the 2-hourly averages were not even violated. So in that sense, I think, good chance that we'll make a new high. So even if you open 100 points up, if you get a 20, 30 point dip immediately post that, I think that's the entry point on the Nifty, and I would look at now targets of 25,500.
Okay, all right, got that, Mitesh. Sudarshan, what about you?
Good morning. See, the market has its own wisdom. Yesterday, the view was we should step aside, and that didn't work out. Every dip is being bought in this market, and it's not just India. Even in the US overnight, the dip that we saw 1 day ago was bought into. So world over, the markets are saying we want to go higher. In India, that message is even louder and clearer. So today, I would suggest buying the Nifty and buying the Bank Nifty. The Bank Nifty had a very narrow range yesterday. That narrow range is going to be broken on the upside. That's a buying opportunity. So go long in both the indices.
Okay, all right, gentlemen, stay with us. We'll slip into a short break, come back, and we'll get the picks as well from Sudarshan as well as Mitesh. We'll also focus on the metal space. We'll have Aditya Velikar, the senior research analyst at Axis Securities, who will be joining in to give us his take on the steel space.
Welcome back. So let's go back to our technical experts and get some individual stock ideas going as well. Good morning, gentlemen. Mitesh, let me come to you first. So in terms of stocks, what would you work with today?
Yeah. Morning, Sylvie. I have more of buy calls. Pidilite is on the buying list. Yesterday the paint companies did well, and I think falling crude oil is helping over here. So Pidilite also looks like getting into a buy mode. Sorry. Looking at a target of 3,300 and a stop at 3,180 is what I recommend. A buy on GNFC with a stop at 684 for targets of 730. Dabur is a buy with a stop at 636 for targets of 680, and one sell call, that's Bank of Baroda. Keep a stop at 249.5, look for targets of 230.
Okay, and Sudarshan, what about you? Stock ideas for the day?
Well, it's also mainly buying. I'll start with my only intraday short, that's ONGC. And well, I think that's good news in the sense that crude prices are coming down. So we don't mind a small dip in ONGC. It's an intraday short with a stop above 320. Everything else is a buy. Astral is a buy with a stop below 1915. And there are two cement companies. Shree Cement, both of them had done well yesterday. Expect continuation today. Shree Cement is a buy with a stop under 25,350. And Ultratech is a buy with a stop under 11,380.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's get in a quick word from Hemang Johnny before we let him go. Hemang, yesterday I noticed that Biocon spiked up in trade, and a couple of other pharma names as well did well. How are you all positioned in the pharma space?
So Nigel, this quarterly numbers have been extremely good. The sector grew at almost 22%, and most of the management con calls, they were suggesting that the outlook, both in terms of US generic market, India market, remains positive. I think Biocon, probably the market is again trying to see if there is any kind of M&A kind of an activity, or some kind of an indication from Dr. Kiran Mazumdar's show on the succession planning. So I think you may have, some news flow around that which could have caused this up move. But overall, we continue to be very positive on the pharma space, particularly some of the mid-cap pharma companies, Laurus Lab, FDC, some of the companies that would benefit because of the cut in the GST on cancer drugs. I think those are the pockets where we would expect good action.
Yes, absolutely. That story was done by our colleagues. It was a CNBC-TV18 exclusive, and one of the drugs which potentially could get this relief is trastuzumab, which is, of course has been one of Biocon's major cancer drugs as well. Got it, Hemang. Thank you so much for that. Let's quickly move on to another important development. The Minister of Heavy Industries, H.D. Kumaraswamy, was speaking at an event yesterday, and he addressed the industry concerns on China's steel imports, and he pledged to push for higher tariffs on Chinese steel, which is being imported into India. Let's take a look at what he's promising the industry.
I can understand. I will promise you that the problem which you are facing from the China, for that actually I try to convince our Prime Minister and Finance Ministry to look after about the from 7.5% tax to 10 to 12% your demand is there. For that, definitely I will going to try to convince and to bail out the present problem which our steel industry facing in India. For that actually I will be with you. I am very grateful to you for your achievement and the contribution given to the country from your industry. I urge all of you to bring your minds and expertise together so that as one united Indian steel industry, we can forge a path forward.
So the steel minister says he's going to make a pitch, but Mr. Naveed Jindal says 10 to 20% import duty may not be enough. Let's hear what he had to say.
USA, Canada, they have imposed suo moto 25% duty. Similarly, now Japan, can you imagine? Japan is also asking for protection, Japanese steel industry. So the situation is serious. We are very efficient steel producers, so we can challenge them. But then the steel industry in India, they must have some surpluses also to be able to invest in growth, to be able to decarbonize. Decarbonizing is very important for everyone. So we do need resources to be able to do that. So the health competition must be healthy. So we are only against the unhealthy competition that we are facing from some of these countries, and I'm confident that the Government of India is going to take the necessary steps.
The minister spoke about raising it for 7.5 to anywhere between 10 to 12. Will that be okay for the steel industry?
That would not be enough, because these prices. See, if they were selling at, and we put say 12.5 or 15% duty on the price at which they're selling in the domestic markets, it would be fine. But the market they're losing more than $100 per ton when they are exporting, and which is being subsidized by their governments as per the information that we have. So that's an unhealthy prices. They're not realistic prices. Those are just prices for dumping of their material to protect their domestic industry. But it is hurting our industry, so we have to safeguard against that.
Question is, will we get a duty, and how much will be enough? To help us out with an understanding, we have Aditya Velekar, the Senior Research Analyst at Axis Securities, who joins us on the show. Hi, Aditya. What's your take? If you could tell us right now, what is the landed cost of imported steel coming in from China? That compares with the domestic prices. I understand the domestic prices are still at a premium. So what is that difference? And how much do you think will be enough to nullify that?
Yeah, good morning, Nigel. So thanks for having me on the show. So currently, Indian HRC prices are at 8% premium to Chinese HRC prices, and based on the 7.5% customs duty. So if we increase that customs duty to 12%, then that premium will fall to 4%, which is still not at parity with the Chinese prices. So in order to bring it at parity with the Chinese prices, the customs duty will have to increase to 18%, 17 to 18%. So then only the premium falls to 0%.
Okay, Aditya, so, that's a tall ask to get 16, 17% protection. But Aditya, in the past we have seen, right, Indian steel is normally at a 4-5% premium, I think. Currently it's higher, But normally that's par for the course.
Yes. Ideally, the domestic HRC prices should trade at a slight discount to imported prices in order to incentivize the domestic steel to be the first priority for consumption. Ideally, that should be the case. Currently, the premium is slightly higher at 8%, and even if we go for customs duty hike up to 18%, then the premium falls to zero. So it needs to be above 18% in order to incentivize the domestic steel mills to push their material in the domestic market.
Right. Aditya, has this situation been like this for a while, or something has that gap increased quite meaningfully very quickly recently? I'm just trying to understand what will catalyze action from the government, and should we expect something now?
Yeah, so to put this in perspective, I guess the spot spreads have fallen from almost $450 per ton in last year to the current $350 per ton range. So that is the kind of impact because of this fall in HRC prices, despite taking into consideration the softening of the coking coal and iron ore prices. So if we see on a quarter-on-quarter basis, the spot spreads are down by 1 to 2%. But on a year-on-year basis,
for our viewers, Aditya, what do you mean spot spreads?
So it's the difference between the HRC prices and the raw material, prime raw material, that is coking coal and iron ore. So that spread has,
Go on,
yeah.
please.
Yeah, so the fall in steel prices has intensified from the month of May. So if we consider the recent peak that was in the month of May, so HRC prices have softened from that level by 10 to 11% in Indian market, and even higher level in Chinese market by 15%. So this is the trigger where now the dumping from the Chinese prices has intensified, because they are offering their HRC prices in the range of $462 per ton on a FOB basis. So which is the drop in HRC prices in China is at a higher quantum by 15%. So that is putting pressure. The regional fall in HRC prices in these countries like China, Vietnam, Japan. So that is putting pressure on the domestic steel prices.
Aditya, so I'm going back to that number you made. You said 17 to 18%. That is the kind of increase in tariff we need to protect domestic producers. Now, we don't know how this, raising the customs duty itself may not happen. You might have this anti-dumping duty as an additional duty, right? So total tariff goes up to that level. Apparently, I was reading that investigations have been opened into Vietnam as well, dumping of steel from Vietnam. So that's also a concern. In the past, whenever steel has enjoyed an anti-dumping duty, typically what is the kind of range? So realistically, the minister himself is saying that he'll push for 10 to 12%. Mr. Jindal is saying even that will not be enough. But realistically, in the past, if we go by history, then what is the kind of anti-dumping levy that the steel sector has managed to get in the past? So then we work with that at least as a reference.
So I recall, so currently the customs duty is 7.5%, and that is only for China. For countries like Vietnam and where we have the FTA, that is free trade agreement, there is no customs duty for the steel imports from these FTA exempted countries. So the problem is the China is rerouting its steel from the countries where there is an exemption from customs duty perspective. So either the FTA, the point is means either we have to increase the customs duty on China, but that will also get circumvented if they route the steel from these free trade agreement countries. So the recent customs duty which we have seen is 7.5%, and I don't recall more than that as a customs duty we have put in the past.
Okay, Aditya. So the big takeaway is that duty needs to go to 17-18% to totally protect the domestic steel industry. And I think we'll have to keep an eye out on what's going on in China, because pricing is weak out there. They're consuming less. And because they're consuming less, they're exporting more, which is putting the entire global industry in a bit of a tizzy. Appreciate you joining in, Aditya, and giving us all those cues.
It's not just steel, right? The latest estimates say that they won't grow 5% in China this year. 5%. This is that's a country which grew at 10% plus, like clockwork for 20 years. And now we're not. So I think it's everything. But it's interesting, this entire tariff argument, right? Just yesterday, there was there was a news item which said, and I think we reported it as well, where a lot of the industry, not steel, but other industries were saying that we should actually have we should have easier imports, etc., for industries where we don't have capacity still built up.
So there are some protests in areas like Ludhiana, the MSME sector over there.
Who are saying
who are saying, let it come. What's the problem? Because we like cheap steel. But obviously, that's the delicate balancing act that I guess the government has to look at.
Yeah, but it's tariffs, I mean, generally are going up around the world, especially with regards to steel and everything else, of course, which is going to go out of China because they've got, of course, the largest capacities for pretty much everything. We'll get our 9-10 calls going as well. Sudarshan is here to help us with that, and Mitesh is with us as well. Sudarshan, what do you have?
Well, consider buying Astral with a stop under 1915.
Mitesh, what about you?
I would recommend a long on Pidilite for targets of 3,300.
Okay, both from the similar kind of space, Pidilite and Astral. Home improvement, but those are technical calls and coming in from Sudarshan and Mitesh. Well, let's talk about AU Small Finance Bank, Chola Investment once again. Abhishek is here with details. Abhishek.
Well, Goldman Sachs has initiated coverage on both the stocks. So on AU Small Finance Bank, they have given a buy recommendation, target price of 831 per share. They say that it's ready for the next innings. So sector leading EPS growth beckons this investment call of theirs. They forecast EPS growth of 27% CAGR over FY24 to 27, and they estimate return on asset to improve by 14 basis points during the same period. So robust loan growth will drive, this ROA improvement, especially by the commercial retail portfolio. On Chola Investment, they have initiated with a buy call and target price of 1,786 per share. They say that market share gains amidst commercial retail upcycle augurs very well for the company. So they expect Chola to deliver an EPS CAGR of 33% over FY24 to 27, during which the ROA profile of the entity will improve by 24 basis points, driven by robust loan growth as well as gain in market share in many of the product segments that they cater to. Back to you.
All right. Abhishek, thank you very much for that. So those are two names to watch out for, but agri names also perhaps in focus. HSBC is out with the report. Sudarshan is here with details. Sudarshan, morning.
Morning, Prashant. So HSBC has written on agri input companies. It has a buy call on UPL, PI Industries and Dhanuka Agritech, and hold call on Bear Crop and reduce call on Rallis. It says both UPI and PI Industries have least exposure to domestic businesses, and the sign of recovery for both UPL and PI Industries in global agriculture is positive. Also, higher area under crop showing a definite positive, and strong rains likely to moderate growth in Q2 for agriculture players. Also, good rainfall to boost water storage, supporting H2 FY25 domestic sales growth, and total overall FY25 expect a healthy growth for agri input companies.
All right, we're just a couple of seconds away from market open, so thank you very much for that. First rates coming up. I mean, it will not be, at least the pre-open is not indicating a 100-point start higher as the GIFT Nifty was. It's a more modest 50 points, and then we'll pick up from there. So the first indication is a 50-point start and a 100-point start in the sensex. So what do we have? So 25,253, that's about 0.2% higher, 0.2 on the sensex as well. We're at about 82,558. So these are the first rates which are coming through. 42 on the Nifty actually, and the sensex looking up as well. The bank Nifty is up 0.25%. We're back above 51,500. The mid-cap index is up about 0.4. So it's a quieter kind of start, which we are looking at. Market breadth is looking pretty positive. 7:1 is the advances to decline ratio. And of course, the heat map on the Nifty, 10 stocks, 10, 11 stocks are lower, but you've got the majority, the bulk of it, opening up in the green. Surbhi.
Okay, so let's take a look at the movers on the upside. You have Ultratech Cement to kick things off. The top mover on the Nifty right now, there's Hindalco. There is Tata Steel. So basically, some of the metal names and commodity names are doing well. Even JSW Steel managing a little bit of a green. And there's ITC on the upside. There's LTI, Mindtree and Wipro from the tech space as well. So very, very mixed trends on the way up. On the way down, there's some cool off in the so-called defensive trades. So Nestle and Britannia, they're down about 0.5%. Not too much, just about 0.5%. The Bank Nifty is actually doing quite well. Bank Nifty is up 180 points. HDFC Bank, ICICI Bank are leading the charge from the front with a gain of about 0.5%. There's Axis up as well. So banks are looking good. And Reliance, like we said, it's in focus for multiple pieces of news, including, PLI for some of their expansion plans. as well as the bonus meeting today. 1:1 bonus will be considered by the board. Reliance is the third top performing stock on the Nifty now.
Well, that's right. You know, the big mover this morning is Chola Investment on the back of a GS note, as well as GS note on AU Small Finance Bank. So both those two, they are the biggest movers today. AU Small Finance now, it's one of the top gainers. It's up close to around 4% and on big volumes. And Chola Investment as well, that one as well is flying away as we speak. So big up move is what we're seeing on both those two names. From the broader markets, another one that's doing very well is NIT. Oh, that's gone from strength to strength. I think around 3 weeks or so ago, it was less than 150. Now it's more than 200 rupees. Stock up 6% as we speak. Massive up move is what we're seeing out there. Suzlon Energy, the street likes what they're doing with regard to selling that asset and leasing it back. So the stock is up close to around 3%. Good move is what we're seeing on that one. We have a large trade on Max Financial, but 3.5% equity changed hands. So that explains why that stock is down 2%, but it's quickly bounced off the low point of the day. So those are the top movers in trade today. Alembic Pharma as well is up close to 2.5%. Zomato is bouncing back. It's up close to around 2% as we speak. So pretty good looking screen. It's not the 100 points that the Gift Nifty was suggesting, but par for the course. We're up 50 points. We bounced up 100 points from yesterday's low. Put it together, 150 points up from yesterday's lows.
You know, Ecos Mobility, the listing from yesterday is up 7%. And it's the second largest volume-led gainer in the market today. It had a decent start. I mean, about 17-18% higher day yesterday on day one. Not as big as we've had with a few others, but good enough. Ecos Mobility, I mean, that's the one I'm talking about. So 476 on that one. So AU and Chola, of course, are the big 4.5% and 4% movers. So both have got very large volumes. We mentioned NIIT, which is coming up at number 4 with volume-led gains. There is Linde India, which is up about 3% or so. IIFL Securities has been having a bit of a move last few days. It was a big one yesterday, and it's up about 3.5% this morning as well. What else? You've got PG Electroplast, which is up 4%. So that's coming at about 590. That's from the EMS space. Kernex Microsystems is up about 4.5%. Again, a stock which is actually which sold off, but is now trying to make a bit of a comeback. And there is Fino Payment Bank, which is also up about 3.6%. I can spot a Zaggle, which is up about 2%. But that's it. I mean, you go down the list and volumes start to fade away pretty quickly. Max Financial, of course, that block and volumes are outsized because of that block coming through at this stage. Garden Reach, some of these shipbuilders, right, from yesterday, which were big movers, they are seeing some profit booking, but not very much. Look at the Max Estates. Max Estates is down sharply. It's down 4%, 630, and it's coming up with some volumes as well. So I'm just only highlighting that because there's been this block in sort of Max Financial Services as well. So I'm not sure if there's any, rub off, but why should they be? But it's down 4.5%. Uno Minda is down about 2%. Marico is down 1/3%. Cummins is down 1%. So that's essentially the lay of the land for now. 1,700 stocks are higher, and you got 400 stocks which are up in the green at this point in time. Well, we have our market master of the day with us. Mahesh Patil is joining us. Mahesh is Chief Investment Officer, Aditya Birla Sun Life Asset Management Company. Mahesh, good to have you with us here. Thank you very much for your time. Mahesh, let's just get a quick sense on this entire flows picture. At a net level, what is the industry averaging at? If you can give us the latest, for this month as well. Are flows holding on both on the SIP and discretionary side, and where exactly is the money going?
Yeah, good morning, Vishal. So I think the overall in the last 3 months, we have seen that the net flow numbers for the industry have been clocking a much higher number than what it was average of last year. And I think that broader trend continues, it seems like. I think we don't have the exact number for last month. But I would say clearly the net flows still remain fairly strong. The SIP flows are strong. What is the trend? What we saw last couple of 2 to 3 months is that out of the net inflows, large amount of money came in the thematic funds, right? So there were a lot of these NFOs which were there on the thematic side. And that's where the larger, more than say around 40% of the inflows were in that category. But one interesting trend, possibly what we are seeing is that there is some interest coming back into the hybrid funds, and also some inflows coming into the flexi cap and the large cap category, compared to say last year, okay, where we had seen this category was totally ignored. So I think that's a kind of a subtle kind of a change of what we are seeing. But by and large, I think the money inflows into the markets, into the mutual fund industry seems to be still on a steady wicket.
Oh, absolutely, Mahesh. That's the big trend that we've witnessed over the last couple of months now, right? Thematics is where the action is, and that's where the money is coming in. But, what about valuations? Because obviously there is product innovation on that side, and you're seeing, and now there are a lot of passive products, passive thematic funds that are coming in as well, and they're bringing in the money. So what about valuations in some of these themes like defense or manufacturing or infrastructure? Because this is where we've seen a fair amount of, newer products as well when it comes to thematic funds. So how do you see valuations in these specific pockets?
Yeah, so I think in some of the themes, yeah, clearly they have kind of, there's a lot of fancy which has been there, and we've seen a lot of money chasing some of these themes. And in broader market, if you look at it, in the sectoral themes, yeah, in some of the pockets, the valuations have moved ahead. But I think some of the themes which have come in, also the outlook there, right? One has to really look at the long-term outlook on this theme is still really good. So there could be period of pause, or there could be period of consolidation in some of the themes, and investors who are coming into these thematic funds should really look at on the perspective whether the where you are early in the theme or the mid cycle of the theme or in the late cycle. So clearly, if you're in the late cycle, then clearly one needs to be very careful. But even if you're in the mid cycle, I think that should still be okay if you have a slightly, say, with a 2 to 3 year view horizon. But I think I would say that it's time now to really look at more the diversified fund, right? Because as I said, in the last 1 year, we've seen that the market breadth has improved significantly. So a lot of the side of the market has gone up significantly, and which is also reflecting the fact that if you look at the number of stocks, okay, say in the BSE 500, which have kind of outperformed the BSE 500, say by at least more than 10%, that number is the record levels. And that's because of some of the themes, the sightings which have played out. And that's where the valuations are looking a bit stretched. But if you look at the broader Nifty, right, there the valuations, if you compare to FY19 levels pre-COVID, and now it's only about 7-8% higher. So I think that's where the larger comfort is. So I think it's time where people start putting money into the more diversified fund, where the risk mitigation would be much better.
Right. I just want to quickly highlight Zomato. It's taken off like a rocket. It was not there in the mix earlier when we sort of were looking at the stocks and what was moving. But the Zomato intraday will come up on your screen, and look at that. So actually there was a lower start on Zomato, and then it has moved up to where it is now, which is a full 10 rupee turnaround coming through on that one. The other one is Edelweiss. I just want to make a quick mention. Edelweiss, I mean, the low yesterday was $104. It was a late surge on Edelweiss yesterday, ended up about, I think, 4%. It's another 3.5-4% this morning. So just sort of two new names into the mix this morning. But there is lots more in terms of individual names which are coming through. Nigel.
Yeah, all right. Well, hi, Mahesh. Good morning and good to see you, Ben. What's your view on these new age themes? Zomato, I think the other trigger, the technical point is that it could come into the FNO. If it comes into the FNO, then it will be eligible to come into the Nifty as well. That's what the street is hoping. Your view on these new age themes, some of these concept stocks, Zomato, Ola, a lot of them have done quite well. Your view?
Yeah, so I think some of the new age companies, okay, we've seen now they have come of age, right? In the sense that we are seeing profitability coming in both, say, at the not only the EBITDA level, but also the PAT level. So now they are, while their growth continues to be on the higher side because they're still in the early stage of their growth, or probably the mid stage of their growth. But I think now we are able to value at least some of the companies which have now been there for some time and are turned profitable more from a traditional valuation matrices which are there. But I think then again in the new age company, we have to be careful in terms of really looking at whether the unit economics are really making sense, right? So if the unit economics are not in place and at the unit level you're not making a profit, then we would be slightly wary about that in terms of trying to enter that and taking any large position over there. But a lot of these names which are there, which have now established unit economics and have got the scale and size, and more importantly, established their dominance, okay, at least in that space where they are. So I think these companies are now where investors can really look at it. And obviously, since these are high growth companies, high value, we have to be careful in terms of when we are entering into. And on a quarterly basis, one needs to monitor in terms of what is their delivery, if they are really sticking to their growth or they're faltering, because here the volatility will be much higher, right? And if they falter on growth in any of the quarters, I think you could see a larger derating. So that's where investors need to really keep in track whether they are really tracking the kind of performance or the expectations which the market has from these companies.
The market's come off, right? I mean, 25 odd points is what you have on the index, 25,200. So just about holding. And we were saying this, I mean, the global picture is, I mean, at least the handover was better, but it's neither here nor there. You know, generally, the big data point out of the US is tomorrow's jobs number. And markets would be broadly quite wary about sort of going big one way or the other before that number. And that is only, of course, around the time that the US markets start to trade on Friday. So it's a bit quiet overall so far as far as indices are concerned. Edelweiss is now up 6%. So that's actually, you know, flying now, 121 on Edelweiss. But there is so much more. Kaplan Point is up 4.5%. You know, you've got Kernex, I mentioned. Craftsman Auto is up about 4%. So 62.52 on Craftsman. I could go down the list, but yeah, volumes are still about picking up. But this is the bulk of what is going on out there. Mahesh, just a quick view on you know, banks, but more importantly, NBFCs, right? I mean, if indeed we are in at that point where rates will start to come off, what do you think? You know, should one stick with some of the larger banks, or do you think it makes sense to look at some NBFCs, etc., as well? You know, on the housing side, companies are keenly awaiting how this new PMAY 2 will work. So that'll be important for them. But generally, how's the environment? And what is a better bet right now? Some of the NBFCs or large banks?
Yeah, so I think one is, I think we are now getting into the rate cut cycle, right, which will start shortly. I think you will see that now in this month in the US, okay, the Fed move, I think that will kickstart the rate cut cycle. And that should be positive for the NBFCs, I mean, additionally, because where you will see them benefiting on the cost of fund side. But I think more important on the financial services side is to look at on the two aspects. One is on the asset side, right? So I think NBFCs, okay, which are, because asset quality cycle has been fairly benign at this point in time. And there are some pockets of risk which are coming up, okay, at this point in time, especially on the unsecured side, which one has to be careful. So I think NBFCs which are doing pretty, I mean, on the asset side, good underwriting, more on the secured book, right, which is the vehicle finance book or the mortgage finance book. I think the comfort would be much better. Also on the liability side, again, we've seen that there has been some of the challenges, at least from the bank lending to the NBFCs. So they're stronger, and the larger NBFCs, I think, are where they will continue to get advantage in terms of the liability side, both on the cost of funds and also in terms of the supply of funds over there. So I would say if you're able to categorize NBFCs, the larger ones, the stronger ones, okay, on the asset side, which are much secure lending, I think those should do fine in this rate cut cycle going forward. And as far as the banks have concerned, larger banks, I would say that the rate cut cycle plays out. You might see some margin pressure, okay, which could be there, but I think they have already kind of discounted, I would say, because the underperformance in bank for the last 1 year, what we've seen is pretty much there in the price. And it's more to do with your credit growth, how that picks up. I think that will drive the outperformance in the banks.
All right, Mahesh, we'll leave it there. Thank you very much for your time. It's really a pleasure having you here. and getting that perspective across. So 27 points on the Nifty, so it's very, very quiet. I mean, actually even off the day's high, so to speak. Well, let's focus on HDFC Life. The insurer had guided for a 15% APE growth in FY25. But with the first quarter earnings coming much stronger, my colleague Yash caught up with the company's MD and CEO, Vibha Padalkar, began by asking her if there could be an upward revision to that full year FY25 guidance from the 15% stated aim. Let's listen in to some of that conversation.
As of now, given that there are some fairly significant regulatory changes on the anvil, we are holding what we said. Okay. Internally, of course, we're targeting a slightly higher number, but we had said 15%, which is on the upper end, on a full year basis. Yes, it's looking pretty good in terms of first 4 months, and like you said, upwards of 30%. But let's also be honest that there was a base effect.
Correct.
And so numbers for us and for everyone else is slightly looking more elevated. On a 2-year CAGR basis, it's in the mid-20s. And that's what, so it's not very different to where we are saying 15% internally targeting a little bit higher numbers. But I think I'll have a better view once the surrender charges and that new regulations are implemented. Lots of things will undergo a change. And I think right now we just want to go with focusing on business.
So 15% is the conservative view that you would want to share at this point of time, but there is an upward or a positive bias internally that you have.
I
is
would
that
think
the correct?
So. All things being equal, on the regulatory front, 1st of October it comes into being, because then you can build a business model around it, and with very little in terms of further changes. Then with the stability of business models, yes, there should be a bit of an upward bias on it.
Okay. A little on the value of new business as well. Do you expect that side, which will of course be a function of the margins also, but do you expect it to grow in tandem with the APE growth? And you've spelt out a 4-year target also towards that.
That's right.
But would it grow every year for the next 4 years in tandem with APE growth, or could it exceed that?
It's become a way of life that at least you will double your VNB every 4 years, regardless of the ups and downs. And there will be very young sector, and there will be something or the other that we have to look at from a business model change perspective. And so nothing has changed. That's what we have been delivering in cohorts of 4 years, and we will continue to deliver. Again, top line doubling and VNB doubling.
Okay.
And nothing's changed, and I want to assure you that nothing has changed. So I'm saying whether it's 4 or 4.25 years, so we are saying about 18%. Between 17 to 18% is 17.5, 18.5. You know, that kind of a range is what we have been delivering, and that's what we are internally targeting.
Now, you've said in the conference call after the first quarter that you expect ULIP share to moderate. Now, I assume that large part of that, significant part of that moderation, you are indicating that it will come because the other product categories will grow, will take a higher share, and not ULIP share will come down largely. In that situation, I want to understand, by the end of this year, with other product categories growing and taking a higher share, where do you expect the ULIP share to be over where you ended FY24? And in terms of margins, if that moves as per your understanding, the ULIP share, onto your margins, where do you see them? Where do you see yourself ending FY25 at?
I don't even have to wait till end of the year.
Okay.
We are already there. Okay, so happy to share that whatever we have said, that ULIP was elevated thanks to the markets. It's already coming close to about a third of our business. Some of our channels are sub 30%.
Okay.
Right, so it's already been achieved. Our non-par, I'm happy to share, is growing and in the first quarter itself grown by about 41%. We've already started demonstrating that ULIPs are quite at a range that we are reasonably comfortable.
ULIPs, of course, coming in the comfortable range. By the end of the year, by the next couple of quarters, which product segment do we see actually accelerating as a share of the individual APE where we stand today?
Definitely non-par. And like I said, we've just launched this blockbuster product. So that's showing very good traction. Also, in terms of the impact in the new regime, it's something that we have been talking to our partners and seeing how it can be mitigated. So if that settles down, then that product, that segment should do reasonably well. term is continuing to grow faster than company level growth. And so we had about 28% growth in term in the first quarter. On sum assured basis, very good numbers, about 46% on retail sum assured that we've shown growth on. So term should nicely continue to increase.
You've told me protection will grow. You've told me non-par will grow. You've told me ULIPs have come down. What does that leave you in terms of an estimation on the margins for the year?
This year, like I have articulated on our call, we're not tethered to a margin. Last year we ended 26.3%.
Correct.
I don't want to be tethered, and I'll explain why. At the same time, the caveat is we are not looking to drop margins by 400 to 500, 600 basis points, which has not been unusual in our sector.
Correct.
So I'm not talking about that margins could be free fall as long as I give the top line. Like I mentioned to you, that's not what I'm saying. Now I'm saying that, like in our earlier part of today's interview, that I will grow top line, I'll double over 4 years. I will do the same thing in terms of VNB.
Correct.
Margins will be range bound, give or take 26.3, 100 basis points, 150 basis points here or there, it could be, because my focus and the ranking of priorities has been top line growth, so that we continue to be slightly higher than overall industry.
Correct.
Second is VNB growth. Margins will be an outcome of that. Only reason I'm saying that is because of unit link. The fact that equity markets are still very, very elevated, I don't want to say no to good business, although it comes in through the door as unit linked.
So, because you had mentioned that you'd be willing to trade off some downsizing of margins against growth, just to understand that downsizing won't be plus minus 100 basis points. Is that what you're saying?
No, I'm saying it could be 100 basis points lower.
Yes, exactly.
As long as I can give you the VNB growth.
What came in that strong story for protection that we were talking about, and do you expect this to continue for some time, or do you expect this to bounce back if it was just a one-off from the next quarter itself?
Yeah, so let me deconstruct it. Like you said, retail protection, very strong growth. Credit life was flattish, and hence overall number as a percentage came down.
Okay.
Credit life, there are 2 or 3 parts into it. So the MFI book is about 1/3. And we know that the pain, a lot of the MFIs went through in quarter 1 and are continuing to go through.
Correct.
Similarly, some of the NBFCs are also going through fair bit of pain. And we also believe in right pricing. So what is the pricing commensurate with the claims that we are seeing? That triangulation means that little bit of slowdown that we saw. On HDFC book though, we are fairly optimistic about getting a pickup in the second half of the year.
I know I've spoken to you about growth, but I want to make the month of September an exception. October is when the surrender value guidelines kick in. Simply, I will of course get to understand surrender value and its impact from you. But simply to put it that way, is there a strong sale from the end of your distributors before the new surrender value or the higher surrender value guidelines kick in? And in that sense, could September be a very, very strong month in terms of sales, just on the back of making the most of the last 15 days?
It could be for the sector. It won't be for us. We will not do any fire sale. The paradox is these products, why is our regulator bringing out these changes? Because the products are going to be better for the customer. What is the implication of a fire sale? That means something good is going to go away and hence buy something in a hurry. The products are going to be more customer friendly. So we will stay away from a product sale. And we've had conversations with our partners that we will not do any fire sale. Is the word coming in from Ms. Vibha Padalkar of HDFC Life. We'll take a break on that note, come back on the other side. And Arnab Banerjee, MD and CEO at CEAT, will join in to talk about the company's business outlook.
Welcome back. Well, keep an eye out on HAL. We had some flashes that were at the bottom of the screen for you. The GE Aerospace to commence delivering F404 jet engines this month. So that's the piece of news that's come in there. For the time being, the stock is a little bit lower, but those flashes were down for you on the screen. In a bit, we'll just try to address that piece of news as well. Well, see it. That's the next management on the show. The stock is up close to 20% in 2024, but the rising domestic rubber prices, well, they've been a bit of a headwind. In fact, we have rubber prices that are up 50% in 2024, though there were signs that it's cooling off a little bit from the top. To help us out with how are the demand trends, what's the volume guidance, and what does it mean in terms of profitability, we're joined by Mr. Arnab Banerjee, the MD and CEO of CEAT. Hi, Mr. Banerjee. Good morning, and always good to speak to you. Thanks a lot for joining in. Well, let's focus on the pricing side. You had hinted that price hikes are likely to be taken up. So could you tell us in Q2 so far, what are the price increases that have been taken? Are you intending on increasing prices yet again? If yes, by how much? So you're on mute. We'd like to listen to you. So, if you could unmute yourself.
Sorry, the price increase actually took off by the end of Q4. So if you track from April till July, August, we have taken up about 3 to 4% price hike already in truck bus radial, about 3% in passenger, and somewhat less, about 1.5% in the two-wheeler category. But it's inadequate to cover the raw material price hike. Natural rubber has been trending at 30 to 40% higher than what it was in Q4 base. And synthetic rubber and imported natural rubber, everything has moved up. So the entire basket has moved up. I think we should be taking another 1 to 2% price hike. It's required. And we plan to take some of that in the month of September itself.
Year to date, in this fiscal so far, it's around 3 to 4%. And you're looking to take another 1 to 2%, right?
Absolutely, that's replacement market. OEM price hikes come with indexation lag of 1 quarter, which is coming.
Got it. All right. I want to ask you about natural rubber prices. As you said that on a per kg basis as well, I was looking at the trend. I think it went from around 180 also to more than 200 on a per kg basis. You can correct me on that number. I think it peaked out at around 210 rupees per kg. So as of now, what is it? And what is the trend going ahead from here on?
See, it went up to 240, even 250, 260 levels also for a short period of time. It's around 220. As we move from Q2 to Q3, we will enter the tapping season. Right now, also, it's a low demand quarter, usually monsoons. So we expect this rate to stabilize at around maybe 200. It's anybody's guess. The problem is that we are a rubber deficit country, and there are not enough stock available in the market, which is what is also fueling the price. So we had to resort to imports, which is covering the production requirement a little bit. But overall, I think taken together, we would expect it to stabilize by Q3, and then maybe, hopefully, in Q4, Q1, it should come down.
Sir, just want to get your sense on overall demand, because when we look at the aggregate numbers, we just got FADA numbers, retail level numbers just now, half an hour back. And the picture seems to be showing sluggishness. I'll just read out the numbers. Passenger vehicle sales, they're down 4.5% year on year. This is everybody aggregate put together. These are FADA numbers. They're down sequentially. Total retail sales are up only 2.8% year on year, down 7% month on month. And CV, of course, let's not even start. The CV cycle has been unimpressive for many months in a row. It's only the two-wheeler space that seems to be bucking the trend. Isn't there a demand concern that's building up? And are you confident of delivering this double-digit growth that you guided for earlier?
Yeah, so let me throw some light on the numbers that you just spoke about. Those were OEM sales number, right? So OEM business is about 25 to 27% of our portfolio. That is impacted by the numbers which you just shared, and they're correct. The replacement growth is somewhat better, right? And the rural growth, as I mentioned in the last conversation, it's coming back. If we look at our farm or two-wheeler sales, then the rural growth is actually higher than urban growth in replacement. This is happening after a long time. And we expect this trend to continue after the monsoons. About 55% of our sales is actually replacement sales. So that is where we expect a high single-digit growth in 2-3 wheelers, a mid-single-digit growth kind of thing in passenger. And we expect the commercial vehicle space also to have good single-digit growth in replacement. As far as OEMs are concerned, we understand that the second half for commercial vehicles will be better. It's true that it's stagnated because of elections, and Q2 also is kind of flat. Two-wheelers are doing well, but two-wheelers are catching up on the pre-COVID levels now. And finally in this year, they will catch up with the pre-COVID levels of volume. And passenger is down on a very high base of last year. That's the OEM. We also have a 20% international business. So there the order books are looking good, very robust. We are growing in very, very high double digits in international. And we have a very strong outlook in second half. So overall, we maintain the outlook of double-digit growth in this entire financial year.
Mr. Banerjee, hi, good morning. On margins, sir, did you put out a number for 25? Would there be like 100-150 basis point compression over 24?
So first quarter numbers, it's impacted. The raw material price hike and the mismatch between the finished good price hike will continue in Q2. So margins will be under pressure in Q2 as well. Then we will see if the prices moderate. Usually the margins come back in the second. It might come back a little bit up in the second half. Overall, I think it will be lower than last year.
Okay. Is there a sensitivity that we can work with? I mean, obviously, in terms of rubber prices and margins, how does it move? I mean, the relationship now, and has it become a bit more flexible as compared to the previous years? I mean, so it's not entirely dependent on how rubber prices move, or is it still as dependent?
No, rubber prices is about 30 to 40% of the portfolio of our RM basket. And if you look at the passenger segment, which is the two-wheelers and the four-wheelers, which is what is selling well in replacement and the international market. And for us in OEM also, we are looking forward to good growth in two-wheeler and four-wheeler in the second half because of the visibility of models and the brand fitment. So that is more dependent on synthetic rubber and less on natural rubber. Natural rubber is a bigger constituent of the truck bus radial segment, where we are a smaller player, relatively speaking. We have a single-digit market share. So to answer you directly, I think the degree of freedom for our portfolio vis-a-vis natural rubber is a little bit higher, but still it is significantly dependent. And we have to calibrate our price hike based on natural rubber price.
All right, Mr. Banerjee, so just to sum things up, in the first half of the year, things will be under pressure. Q1 had some marketing cost, raw material costs were higher as well. So first half of the year, margins will be subdued with the recovery in the second half of the year. And put it for the year together, it should be 100 basis points lower than last year?
Well, I can't exactly say, but
directionally, it would be that way?
It is likely to be lower than last year, yes.
Got it. All right. Also, I wanted to ask you about the exports, because I think exports is margin accretive as well. So you said I think it is around 20%, and the endeavor was to take it to around 25%. By when does that happen?
We have given ourselves 2 to 3 years time to make that happen. Actually, if you do the maths, 20 to 25% saliency increase means doubling export in 3 years. And we are gunning for that. And we are looking at LATAM, US. US, we've just launched the trucks radial. Europe, for 3 categories, which is agri radials, passenger radial, and truck bus radial. So we are on to doubling our turnover in about 3 years, which would lead to around 25% saliency.
Got it. There was some focus on EV tires as well, with platform wins, I think, in two-wheeler, passenger vehicles, and various other segments. Tell us, how much does it constitute of a total mix, and what's the the way ahead from there?
So right now, EV tires, for EV tires, we are looking at how we are doing in the OEMs, with the OEMs, the two-wheelers and the two-wheelers primarily. We are about 25 to 30% share in both two-wheeler and four-wheeler OEMs in EVs. The replacement market will pan out with a lag, and customer education is required, to buy the right tire for the right vehicle. So we are not really tracking that now, but we are happy with what we are achieving in the OEM segments.
All right, Mr. Banerjee, we'll leave it there. Thank you very much for your time, sir. Good luck to you and your team. Thank you. Just want to quickly pull up the market briefly. I think the Nifty almost went into the red and then it did not. So we're up 20 points now. It's of course off the highs by 30, 40 points. But look at Zomato, which we were talking about earlier. It's a 6% pop on Zomato. So that's essentially the stock of the morning. The start was lower. It picked up and that's a 14, 15 rupee sort of gain coming through on Zomato. The high, by the way, recent high was 280, 281. A bit of a frenzied move with all those calls, etc. coming through. And then it started to correct a little bit. So today it's seeing, once again, a bit of a bid. We'll take a quick commercial break here. We're going to come back. Okay, I think what we'll do is we will get you the next conversation, really. Anchit Nair is Executive Director and CEO Beauty at Nykaa, a phase that you don't see very often, sort of on media. Now, Nykaa is planning to open 40 to 60 stores every year, and a lot of these stores will come from smaller towns. My colleague Shilpa Ranipeta caught up with Anchit, began by asking him about the growth trajectory for the company. Listen to a slice of that conversation.
If you look 5 years ahead, by 2028, this market is expected to be roughly a $35 billion market. And online will contribute to roughly a third of that. And the remainder will be coming from the offline channels. So the category as a whole is growing at roughly 10 to 12% CAGR over the next 5 years. And this is the fastest growing BPC market in the world. Now, if I also add to that a layer of a per capita spend, if you look at it in India today, the average Indian spends roughly $15 on beauty and personal care. 1.5. That is the lowest per capita spend in the world. So we always see this as we're in the earliest of innings in terms of our beauty and personal care consumption in India. This is a multi-decade growth story. And I think Nykaa, who plays a large role in growing this market. We have 200 stores across 70 cities. And we have 25 million plus customers on Nykaa app who are shopping from pretty much every pin code in India. So we've brought beauty to the doorstep of these smaller towns, and we've made it a lot more accessible and convenient for them to get the best global brands at the click of a button.
Right.
And I think that is also what has led to this accelerated growth in demand, even from the tier 2, tier 3 towns.
But how much how big is that tier 2, tier 3 town pie for you, both from an offline perspective and online? And offline, I mean, when you go to add more stores also, how seriously are you looking at that pie?
Yeah. We see a massive opportunity in these smaller towns. I think historically we've disclosed that 60% of our business comes from tier 2 and beyond. And that number has stayed relatively constant, but because tier 1 is also growing nicely. See, as I said in the beginning of our interview, that consumption in India is low in general. Even in tier 1 towns, the consumption is much below where it could be. So all tier 1, 2 and 3 cities are growing in terms of their awareness for this category as well as their consumption for this category. In terms of physical retail, as I said, we're across 70 cities today, and the plan is to get to about 400 stores across 100 cities over the next several years. So we're halfway there, exactly halfway there. If you look at our retail expansion, we opened 100 stores in the first 7-8 years of Nykaa's journey. In the last 2 to 3 years, we've doubled that. We've opened another 100 stores. And if I look ahead, we've said that about you'll see about 40 to 60 stores over the next several years, every year. And a lot of these will come from smaller towns because now we're quite well penetrated in the larger metros.
Right. And I want to talk about categories. That was another interesting thing. So in the report, it said skincare, makeup, hair care, fragrance are the fastest growing categories currently. Are these the fastest growing categories for Nykaa as well? And I just sort of want to understand the kind of growth that you've seen in these, and how are you then playing to these categories? Is fragrance one breakout opportunity that is there for you as well?
So for us, makeup and skin have always been large categories. Fragrance is a unique opportunity for us because Nykaa is seen by the consumer as a trustworthy platform. A lot of horizontal marketplaces in India are open marketplaces. And therefore, the authenticity of the product that is being sold can never be guaranteed. Right. Whereas us, Nykaa, as a inventory-led model, we are buying directly from the brands. And so the product which we retail on our platform is 100% authentic. And I think that is an important peg, especially when selling high ASP items like fragrances.
Right. I mean, how do you see the mix between these categories then going forward? Say, I'm talking about the sales mix.
Yeah, so I mean, makeup, I would tell you pre-pandemic, makeup was 60% plus of our overall business. Today, it's a third of our business. Skincare has been the big standout over the past 5 years.
Yeah. And, given the opportunity that you've outlined in the report that's there for growth in the beauty market, how do you see the average basket size per order then now growing going ahead in the medium term?
The baskets as a repeat customer is growing with every subsequent purchase. And that is the beauty of a platform like ours. We're able to, through education, through content, through assortment, continue to increase the size of the basket of our repeat customers. New customers, on the other hand, are new to the platform. And in many cases, they're new to the world of beauty. So their basket size might be slightly smaller than that of a repeat customer. But that's where the Nykaa magic kicks in. That's where, once they've made their first purchase, we're able to really influence them, to drive them to buy more items with every subsequent transaction. So the average basket size of repeat customers is growing nicely, average basket size of new customers is growing nicely, but at a consolidated level, it's an output of how many new customers versus repeat customers are shopping on the platform.
Okay.
So 80% of our business comes from repeat customers. That being said, we acquire millions and millions of new customers every year. But that just goes to show you that how deeply penetrated the repeat customers are.
Right.
So it's a very healthy mix. If you look at our business having a strong repeat base of consumers and at the same time acquiring millions of new customers, it's a very healthy mix.
Right.
So yes, to answer your question, ABS is increasing for both customer segments.
Right. Fair enough. And the other very interesting piece I want to talk about is prestige beauty, something that's also addressed in the report. Can you sort of tell me currently what's the landscape in India when it comes to prestige beauty brands? Nykaa has brought in a lot of brands globally. How are global brands looking at India? What's the sense that you get? And many have come to India. How has the growth of those brands been? And then going down the line, can we expect more partnerships?
The competition is heating up for prestige, and on top of that, Nykaa is bringing a lot of prestige brands, a lot of brands. So yes, over the next decade, we see prestige beauty as growing much faster than the rest of the category. So that's where a lot of growth will come
from a sales mix,
from.
how much do prestige brands bring in for you currently? And you didn't touch upon more partnerships in the pipeline.
So, again, this is something which we've disclosed in the past, so I can only refer you to the numbers we've disclosed in the past, which is roughly 15 to 20% of our business comes from prestige brands.
Okay.
By value. So it's a significant share, and it's growing faster than the platform. Over the past several months, we launched brands that you saw on the platform, whether it be Fenty Beauty, as I said, YSL also launched with us exclusively, YSL makeup from L'Oreal. Urban Decay was another brand which we bought in, Sol de Janeiro. And now, we don't like to obviously disclose which brands are coming, but you will see some also launching very, very soon.
All right. Well, that was Nykaa, and we have Raymond Lifestyle finally making its debut on the street. There you have some visuals coming in as well. And look at that. The listing has happened northwards of 3,000. Which is already a near doubler from that issue price of 1,563. So that's Raymond Brands, which has the entire lifestyle business, which is branded apparel. It also has the fabrics business and of course the suitings business. Well, with that, let's quickly head back to our technical experts and take stock of the market and the kind of trades we can look at. Mitesh Thakkar is with us. Mitesh, so the market seems to be, holding up, but with a very feeble gain now. So that opening pop is not really lasting. What would the trades be now?
I would agree. I think it's still the breadth which is showing more momentum. And, C8 has just made a fresh high. That's a buy with a stop below 2950. Look for targets of 3120, 3150. So that's doing very well. And the other stock which I have is more of a sell call. NTPC, I think, is not participating in the last few days. There are signs of profit booking happening over here. So keep a stop at about 407.5. Look for targets of 395.
Okay, all right. Mitesh, thank you very much for that. We'll take a break. Manisha will be here to run us through the commodity picture. Stay tuned.
Welcome back. Let's shift focus to the commodity market now. We have Manisha joining in with the latest. Manisha, so what's catching your attention this morning?
Well, it is about the metal prices. You know, today is a steady day and you have seen mixed moves coming in from the metal prices. But if you look at a week-on-week basis, it has been a sharp decline from this sector. Well, to begin with, it has been weak China PMI numbers for manufacturing and services also. And then the street is now anticipating a smaller 25 basis point of a rate cut when we see the Fed meeting happen in the mid-September there. If you look at the prices onwards, then nickel is now trading at a 4-week lows. Well, the prices have seen a decline of almost 23% in the last 12 months itself. Not just nickel, silver prices also are trading at a 3-week lows, and we have seen prices decline onto this one as well, almost off by nearly 7% from its recent highs. The weak US data, the expectations that the solar demand could actually see not as expected growth also is weighing onto the markets. Copper is another one, and it already has seen a decline of 3% for the month of September so far. We have seen inventories continue to gain in China and on LME, and then a BHP statement downgrading the China demand by to almost 1 to 2% for this current year also has been weighing in. Also, when you look at the Chinese inventories, they have been on a surge. The Chinese exports have been on the higher side. Funds seem to be closing on to long positions that they held since the month of April, also is weighing onto the markets. And then you have platinum, that one is trading at a 4-week low. Steel prices have continued to decline. It's down by 23% on a year-to-date basis. And the zinc prices have declined as well. This is because of the supply surplus that the street has seen in the first half of this year, much higher than we saw in the previous year, also has been weighing onto the markets. Well, there has been an interesting report that came in from Goldman Sachs, which says that they have advised exiting long-term bullish cues in sense of copper there. They also have cut the price forecast that they initially put out for the year 2025 by $5,000. Remember, we did see copper prices at an all-time high in the month of May at $11,100. Currently, we are trading at below 9,000. Now, Goldman Sachs has come out with a report suggesting that the copper prices will average to $10,100 in 2025. Earlier, this was $15,000. So that's $5,000 per ton of a cut coming in from Goldman Sachs. Not just copper, Goldman Sachs also is putting a lower and a revised outlook for 2025 for aluminum to 2,500 from 2,850 there. They also are bearish in sense of nickel and iron ore going forward in 2025. The only one thing that Goldman Sachs has put out a report suggesting that they are bullish is in case of gold. They expect an all-time high of 2,700 onto that one in the next year. I will quickly put out a table showing on what the metal prices have done on a week-on-week basis. And as you can see, it all has been on the negative side, with larger cuts coming in for steel and nickel, more than 5% of a cut there, but 2 to 3% of a decline for copper, aluminum and zinc as well.
All right, Manisha, thank you very much for that. So that's commodities in focus. What's happening with Zomato? That's the stock of the day, stock of the morning. Too early to say stock of the day. But Vivek is here with what he's picking up. Vivek, morning.
Well, good morning. That's right. A very interesting note by JP Morgan today. They've gone ahead. They've maintained their overweight stance. They've raised the target price to 240 from the 208 they had earlier. They're saying that, it's spearheading a rapid retail consumer transformation via its convenience as well as selection-focused quick commerce business with ambitious rollout plans. They're also saying it's going deeper across all metros, having proven the model in the NCR region as well. And they're saying that the scale should help it drive monetization from channel margins as well as ad spendings. They're saying that Blinkit now has the license to scale up much faster than peers and the current target. So, higher target price as well as increased focus on profitability as far as the unit economics is concerned is something that's keeping the stock quite active in the session today.
Okay, all right, got it. Thank you very much for that, Vivek. Well, let's go across to Abhishek, because this Goldman Sachs call on Chola seems to be working really well for the stock. Abhishek?
Well, Goldman Sachs has initiated on Chola Mandalam as well as AU Small Finance Bank. With respect to Chola, they have a buy rating and a target price of 1,786 per share. They say that market share gains is seen in Chola Mandalam, especially with respect to commercial retail upcycle that has picked up. So scaling up the non-vehicle business over there should help the reduce cyclicality as well as improve the visibility of earnings growth along with better return ratios. So they expect an EPS CAGR of 33% over FY24 to 27, wherein they expect the ROA of the company to improve by 24 basis points in the same period, driven by the fact that there will be robust loan growth as well as market share gain across product segments. Goldman Sachs has also initiated coverage on AU Small Finance Bank, wherein they have a buy rating and a target price of 831 per share. They say that AU Small Finance Bank is ready for the next next inning. Sector-leading EPS growth is seen over here. So they forecast an EPS growth of 27% with respect to CAGR over FY24 to 27 and an improving ROA profile wherein they estimate the ROA to improve by 14 basis points over the next 3 years, which will be driven by the robust loan growth seen in commercial retail portfolio, which is around 70% of Q1 FY25 loans, despite a normalization of the credit cycle with respect to NPAs. So AU Small Finance Bank is relatively better placed in this cycle, given the fact that there is improving deposit market share, better asset quality growth, as well as, operating efficiency gain, which will come despite the merger that they have done of Fincare Small Finance Bank. Back to you.
Okay, Abhishek, thank you very much for that. So that's Cholamandalam, which has been moving up on the back of that brokerage note. Let's now go across and get details from the new listing. Raymond listed its lifestyle business just a while back, and our colleague Shilpa caught up with the Gautam Singhania, MD of Raymond, to get a sense on how the business will grow from here on.
Congratulations on a wonderful listing. Firstly, just your thoughts on this incredible milestone. Raymond now has 2 listed entities. Just quickly tell us how you're feeling with Raymond Lifestyle now officially on the stock exchanges.
No, it's a great feeling. Always wanted to create shareholder value. And today is a historic day in Raymond. So with the listing of this company, I think we've got a great runway ahead.
Right. A great runway ahead is what you've mentioned, and lifestyle business turning 100 also. Sort of give us a sense then this year, what is the big growth, driver that we can expect from Raymond Lifestyle? Will it be the wedding business? Is that going to be and how much of a share are we looking at on that front?
So the wedding season is strong. As we said, coming up for the next 6 to 9 months, we should have a very strong wedding season. So that should drive strong growth.
Right. And how are you leveraging the Bangladesh opportunity also for the garmenting business? How big do you see that being?
Well, I think the Bangladesh opportunity is great. It's a good opportunity for us to take advantage of. And it's just playing out. So let's see how it goes.
And you've guided doubling your EBITDA also in the next 4 years. What do you see really driving that?
Well, there's a whole business strategy for that.
All right. Thank you so much.
Yeah.
All right, so that's Raymond Lifestyle starting its journey as an individual entity on the bourses, and a big listing there with prices going over 3,000 rupees per share. We'll take a break on that note. Time for that break. After we come back, Lata will connect with Ajay Kamal, MD and CEO of Jana Small Finance Bank, to talk about the company's business outlook.